Now let's continue this conversation and welcome in Anastasia Amoroso, Chief Investment Strategist at iCapital. Anastasia, thank you so much for joining us. Let's talk about what happened today. I guess this rally that had been continuing for the past 4 days will not continue into the close. What happened during the session?
Well, we've seen a lot of this type of price action, just kind of a strong start and fading into the close. And, I really think that this price action in this, dead period of August, so to speak, is really not to be trusted because, there's very light attendance, there's very low liquidity, and I think there's a lack of buying appetite right now. I think what you do see is that any sort of buying appetite is once again focused in tech because that's what people tend to have high conviction in, but nobody's really going to step in right now ahead of payrolls, ahead of the inflation print in September, ahead of the Fed. And so, for now, I think there's this tendency to fade the rally.
Let's talk about today's inflation data. Were you surprised by the muted reaction? It was within line. It came in within the expectations, but did you expect more of a reaction actually?
Well, I think today's inflation print neither confirmed nor denied anything that we have already known. And what I mean by that was we do have this gradual disinflation, and it is gradual. It's not really going in a straight line. It may be stagnating here a little bit, but the markets sort of know that. And there's been plenty of talk of soft landing where you do have inflation easing, but it may not be easing quite enough just yet. So I think that's why we saw the muted reaction. But, if you look at the actual numbers they came in, the month-over-month change was right in line. The year-over-year change, whether it's on the headline or the core PC, was also right in line. So yes, it showed a slight uptick, but I don't think it's really enough to sort of upset the expectations going into the print.
Now we're about to start, well, we're already in the second half of the year, but we're about to start September. So what's your outlook on the economy heading into the end of the year? People are already forecasting what would come for the fourth quarter, but can you give us a quick view of what you might think may happen given the data we've received and how the market's performing?
Sure. Well, it is going to be back to school next week. And, I think with that, sort of you have this race into year end and how do you position? And I do think that after the reset that we had in August, there's a few factors that I'm looking for that are optimistic into year end. And things that I'm encouraged by, for example, is economic growth. And there's a lot of momentum in the third quarter that I think can carry through into the end of the year. Consumer is continuing to be incredibly strong. We had the latest Atlanta Fed GDP update. GDP nowcast update for the third quarter is now 5.6%. So still incredibly resilient. So I think that economic momentum supports stocks, supports sentiment. The other thing that we're likely to have is the Fed that if they don't pause fully, if they don't end the rate hiking cycle, they're going to be much more careful. They're going to go much slower. Maybe it's every other meeting, if not slower than that. So if that's the case, then that's a good environment for stocks as well. And having said that, with 5.5% Fed funds rate, I don't actually think we're quite at restrictive territory to meaningfully slow down economic momentum just yet. So I'm optimistic. And I think after the reset that we had in August, investors do come in September. And as long as inflation cooperates then and the Fed cooperates, I think that should be the all clear for stocks.
Give me an idea of what you think it would take for the Fed to meaningfully slow down the economic action happening.
Well, I think we need to get into significant restrictive territory. And what I mean by that is there's an estimate of the so-called neutral rate for the economy, meaning what is the normal level of rates that neither restricts the economy nor accommodates it. And, if you look at the forecasts and the various economic models, that neutral rate has come down significantly over the years and is just below 1% in real terms. And by the way, when I look at the Fed funds rate, I take out the core PC inflation and I look at the actual real Fed funds rate, it's also just below 1%. So to me, it would take the Fed tightening significantly more or perhaps not bringing down the rates as inflation comes down, and that would get them into restrictive territory. But I think we're far from that, and that may happen at some point in 2024, but I don't think it's a 23 event.
Okay, well, let's switch gears right now and get into some AI. With all the rapid growth that's happening in AI, We've already heard concerns about it as it relates to name, image, likeness in Hollywood. Are you looking at any potential regulatory actions that may happen within AI and impact the investment strategies?
I mean, clearly there are significant risks that are associated with AI. What if some of those AI machine learning models are trained on bad data? What if they have an inherent bias? What if you can't control, some of the bad results that some of the generative AI generates? So there are definitely concerns, but I think it is too big of an opportunity set for the regulators to step in and try to control. I think there's absolutely going to be some regulations, along the way and perhaps along the periphery, but I don't think it's going to be enough to deter the momentum of artificial intelligence. I mean, when I think about, the FOMO, the fear of missing out, maybe you have that in the stock market, but you also have that in the spending surveys, for example, of chief technology officers. And over 50% of CEOs and CTOs are saying that this is the top spending priority. And over 65% of those same technology, procurement managers are saying they're going to boost their artificial intelligence investments in the next year. So I think given this momentum, it is hard to kind of regulate that out. So having said that, I do look at it as an opportunity, and we've had a bit of a reset in some of the artificial intelligence valuations as well. And the implied distance between where the stocks are trading and what the analyst forecasts are for their price targets, that distance has improved. So I think the risk reward has improved for stepping into some of the AI stocks.
That's worth noting because we've been hearing for a while that some feel like it's a risk of an AI bubble, similar to the tech bubble in the late 1990s. But then we started to see actual tangible products and services that are being offered, and partnerships like the huge Google Cloud event that happened this week that showed actual tangible things. So with these tangible examples, do you think it's still a risk of an AI tech bubble?
No, I don't think so. And, you pointed out very rightly that these are tangible developments. If I look at a company like Broadcom, if I look at a company like NVIDIA, if I look at a company like Marvell and a lot of others, they're guiding towards the benefit of AI they're seeing now and they're likely to see over the coming quarters. So it's not just hoping for that benefit to materialize in the next several years, but it's actually here and now. It's nascent, but it is happening today. So that's the first thing I would say. The second thing I would say is when I look at the analyst models and what they're forecasting for artificial intelligence, it's not the doubling in spending on AI that a lot of industry forecasts are penciling in. For example, IDC, for example, projects that spending on artificial intelligence is literally going to double per year over the next several years. That's not what you see in some of the earnings models for AI beneficiary stocks. So I think what ends up happening is, to the extent that we go through this multi-year investment cycle of artificial intelligence, as AI take-up materializes, analysts will mark up their earnings estimates. As a result, the stocks may not actually be as expensive as they might appear because that EPS number is likely to trend higher.
So let's talk about the non-tech industries. How do you anticipate them to take advantage of the AI revolution? I saw something interesting with Deere when it reported its earnings a couple of weeks ago. But how are you anticipating non-tech industries to take advantage of the AI revolution?
I mean, any company, I think right now is thinking exactly that, is how do I implement artificial intelligence in my company? And because if I don't, I am going to be left behind. So AI should be a conversation in every boardroom and every industry vertical, and I'm sure it's happening today. Look, when I think about, the benefit of artificial intelligence, it is the potential for a big boost in productivity. And so that's why every company is entertaining the idea. You boost productivity, potentially you reduce the wage pressures. And, that's why the margins for companies for the S&P is actually forecast to increase as a result of embedding AI.
I think you hit the nail on the head when you said it boosts productivity. It'll take less time to do way more projects and services. And then another trend that we're looking at is the actual IPO market. We've been looking at sort of a return of the IPO. Do you anticipate the IPO market to reach the heights of like in 2021 again in the near future?
Well, that would be nice to see, but no, I don't anticipate that we're quite going to get to the 2021 levels. But I do think that we have a chance here for the IPO window to somewhat reopen in the back half of the year. And the reason I say that is if you think about what is required for the IPO market to function is you have to have some certainty about a level of interest rates so you can actually price up those IPOs. You have to have some certainty about the economic environment. And now with recession fears being pushed off and soft landing being the base case, I would say that's a much more conducive environment for the IPO market. You also have to have some confidence in valuations and making sure that you're not IPOing into a market where valuations are at trough levels. Well, you look at the S&P, you look at the NASDAQ, you look at AI stocks, you look at semiconductors, and the valuations on all those indices have meaningfully increased over the last 6 to 8 months. So you put that together and with CEO confidence, by the way, and that becomes a supportive environment for IPOs. And then I look at the backlog. There's a lot of companies right now that are waiting in the wings for the market to stabilize and for the IPO window to open. So I think if some of the tests, like the ARM IPO and a few others, go well, I think we'll see more companies follow suit.
What about the impact of bellwether unicorns like Reddit, Discord? What kind of impact do you think they're having on the IPO landscape?
I mean, I think all of those, companies succeeding in the public eye is very important. And look, the IPO market has a lot to do with investor confidence. It's investor confidence that would be the buyers of IPOs, and it's also the CEO confidence to actually go into that environment. So I think all of that is part of market sentiment is very important.
All right, Anastasia Amoroso of iCapital, thank you for joining us this afternoon. We really appreciate the info.
Thanks so much.